Yeah, so you can see you're basically just hugging a little bit of support right here. If the dollar continues to strengthen and the Fed seems to want to make sure that it does, then you're going to break this 18 to 19,000 level, and your next stop is not really until that 12 to 13,000 level. That's my best case. That would be if everything works out and everything is fixed and so forth. Worst case, you have to look back to the .com era when Amazon dropped 95% during that collapse. And if that's what crypto's going through, you could be looking at a $3,500 worst case scenario target on Bitcoin.
And you're buying with...
Hello and welcome to Wealthy Value. In today's video, Chief Market Strategist at InTheMoneyStocks.com, Gareth Soloway, updates about his Bitcoin outlook for 2022, his thoughts on the Ethereum Merge and the ongoing bear market, as well as discusses the Fed's motive behind consistent rate hikes. Gareth also talks about the key reasons why he is long Bitcoin and how will Bitcoin's price recover in the coming days. Make sure to stick around till the end of this video, where Gareth Soloway reveals his views on inflation, wages, and makes a shocking Bitcoin price prediction. If you like the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. Let's dive right into the video.
So to be fair, I know enough from my career to know that I don't pick exact lows. Yeah. And so basically in the teens, I'll be already starting to accumulate all the way down below. So basically, you see 16,000, I'll pick up a tiny bit, 13, I'll pick up a little bit more, 10, all the way down there. And the idea there is, I do believe that eventually Bitcoin's 100,000, 500,000. And so I'm not going to try to pick a bottom and miss it. Instead, I'll just dollar cost average in this lower range to build that core position.
Okay, I don't think I've asked you this yet, but if I have, let's revisit this question again. Did you buy with both hands and feet when it went to $20,000? You went on air a couple of times saying if it goes to $20,000 last year, you would buy with both hands and feet. Did you actually accumulate?
Yeah, I did buy back down there. Absolutely. Yep, absolutely. So again, I don't know if it would be called with both hands and feet at that point, but I certainly did pick some up.
I guess the macro conditions turned even more bearish, so you updated your
yeah,
your
and that's the thing. That's the thing that investors need to understand, is that every time you get a new candle on the daily chart, it's a new piece of a puzzle. And a good technician is going to go and look and say, okay, does this change my thesis? Does this change anything? And really what we've seen is the Fed's gotten more hawkish. The economic outlook for me is even more bearish based on the Fed being more hawkish, and that you have to start lowering asset prices even more. Yeah, so I think the key here is to just understand what type of market we're in. When you're in a bear market, it takes a lot to get price to go up because people are scared, right? So, if you're in a bull market, you could have the tiniest bit of news and price will rip up. It could even be news that's not relevant. And we've seen stocks like GameStop, AMC. All these things just go to the moon. But the problem is we're in a bear market, and in a bear market, people really need value. They need to know that something is immediately changing, and the merge isn't doing that, right? Yes, long term, it's probably fantastic for Ethereum, but in the near term, what is everyone focusing on? The Federal Reserve, interest rates, the US dollar, the economy, and all of those things are just crushing risk assets right now. So it was kind of a no-brainer to me that you saw a kind of an early front-loaded run up a few months ago, and then it just kind of came right back in. Well, the narrative that has changed is the Fed has continued to be so hawkish. Much more hawkish than even I thought they would be. I've kind of been in the conservative groove where I'm saying to myself, all right, the Fed needs to be careful here, because if they do tip us into a bad recession and inflation is still above the 2% mandate or 2% sub-mandate, then how do they get us out? The markets are going to look towards the Fed and say, hey, could you mind printing some money and get us out of this like you have for the past 20 years? And the Fed's going to be like, can't do it. We don't have 2% or under inflation. We can't print the way out. And I think that's starting to kind of have an impact here, where the Fed is just so hawkish and just kind of gangbusters ahead. It almost reminds me of an emotional reaction. They know they messed up printing too much prior. Now they're trying to make it up with another wrong, and two wrongs in this case do not make a right. So the markets are headed down. I think we're oversold near term, so it wouldn't shock me to see a bounce next week. But at the same time, I still think the COVID highs just before March of 2020, that has the target written all over it by year end. And again, that's at around 3,385. So 3,385 on the S&P 500. Right. So you're right. 75 was a no-brainer. It was going to happen. The Fed doesn't like surprising on interest rates, so they basically telegraphed 75. The markets had priced that in. What it was when they came out, they raised expectations for the next few hikes. And that's what shocked the market. So it's almost like a stock reporting earnings, right? So the earnings came out in line, but the Fed raised guidance on interest rates. And that's really what kickstarted the selling pressure, because then the dollar took off. Look at the 10-year yield. I mean, the 10-year yield is above 3.7% now. The 2-year is well above 4. I think it kissed 4.2%. That's an incredible inversion and a very scary thing. And one thing that I think, and again, it blows my mind the Fed's not kind of talking about this, or maybe not aware, but when you go back to Volcker back in the 80s, he kind of had this stutter step where he raised from 12% to I think about 18%. That's about a 50% hike in interest rates at the time. Now think about the difference in interest rate hike percentage wise from where we were until where we are now. We were basically at 0, and now the Fed has us what, at 3.25? I mean, percentage wise, this is an enormous hike, way more than Volcker back then. And it's going to have a major impact on the economy. And again, this is what scares me about things is like, it's one thing to say, if we go into recession, the Fed can save the day by coming in and, doing what they've done. But if you have inflation that's sticky around 4 to 5%, which is what I think it's going to be, how do you get us out of it? And are we going to be in a protracted, a long-term bear market? Yeah. And there's no doubt that, you've seen commodities already coming in dramatically. Look at oil today. Oil's in the mid 70s all of a sudden, or in the mid to high 70s. It was just a few months ago, well above 100. So you are seeing inflationary pressures kind of ease a little bit, but what's not easing right now, and I think this is why the Fed is being so hard-nosed, is that the labor market is still demanding higher wages. And wages, again, and this is something that I've talked about before, is that when a company has to double the salary for an employee, they can't just double the price they're charging for a widget, right? So what they do is they'll raise the widget by 10% this year, next year 10%, 10%, 10%, and they make up for it over time, getting their margins back in line. And I think that's the key, is why it's going to be remaining sticky on the inflation side. The input costs are coming down, those will come down, but you have that wage issue that is still sticky. Yeah, that's exactly what it is. And I think it's going to be a lot further out than 2025. And I think it's going to be a very scary situation when again, we do see the Fed continue to raise and push us into a recession, and then they're not able to get us out. And you could just look at stocks or markets like the Chinese stock market, which went from 2003 to 2008. It had this monstrous run, much like we saw over the past 5 years or so. And then since then, it's been in 10 years, actually 14 years of sideways chop. If you look at the Brazilian stock market, same thing, had a huge run in the early to mid 2000s. And then since then, those markets have just been up, down, not making new highs. And I think that's something that US investors are going to have to get used to. Now, as a swing trader, it's a good market. You get the swings intra move. As an investor, it's going to be a tough market. The Fed really pulled forward a lot of the upside. Yeah, and you're right. 5% by no means is good, but it would be nice to see it get back there at least. And I think what you're going to see is, right, so we know that it takes time for lower energy costs to be passed through. So it's going to take a little time for that to filter through. And I also think the supply chain is slowly going to loosen up, right? It just takes time. It was a shock. The Russia invasion was a shock. A lot of these other things were shocks. But over time, businesses will expand their output of various things to compensate, because prices have gone up. And if price goes up enough, it makes a business want to expand and make money off of those products that they sell. So I think those will alleviate and bring us down to 5%. I think as early as next year will be 5 or sub 5, but it's going to then be the last leg of the marathon is going to be the toughest.
So, do you think Bitcoin will ultimately hit $100,000? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.